Hi, welcome back, everyone. And today I'm going to talk about a 22-year real estate journey, investment journey for myself and our several thousand members within our investment club, if you will, the Year Real Estate Networks. And we are going to use a very fascinating article by John Burns, research and consulting, one of the nation's top real estate consulting company. They do consulting for the build construction industry, for the building industries, for all those builders throughout the country. Anyway, yeah, it's a very fascinating article. And the headline is, again, charting a 22-year roller coaster investor activity. As we go through the various periods in the past 20 years, I'm going to relate to my personal and our turnkey mom and pop investors journey and what transpired during every step of the way. And then I'm going to share with my key takeaway. But the key takeaway for John Burns and his company, and let me share. Their key takeaways are they also discuss the institutional investors, meaning hedge funds, Wall Street, those big corporate funds that are scooping up single family homes over the years. And of course, some of you might have heard that a lot of sensational headlines that the Wall Street institutions are buying up too many single family homes, and it affects the overall limited inventory market out there. It's not true. At the end of the day, they are only buying less than 2% of all single family homes, a much lower percentage than the misleading headlines may imply. Okay. You got to watch my video. If not, you need to understand that I will be very transparent, very direct, and I'm going to have strong opinions about all the information out there. There's so much bogus information that are being put out into the social media. So anyway, so I'm going to refute all those inaccurate, misleading just headlines. It's mind-boggling how so many consumers and investors have been totally misinformed and thereby affecting their ability to take action to achieve their own financial goals. Due to the doom and gloom, the sky is about to fall, house is crashing, all those crappy stuff put out by those idiots. Anyway, for clickbait kind of situation. All right, so investors, when you hear the word investors as I'm presenting this video, investors encompass many categories of investors. Of course, our investors are more mom and pop real estate investors are buying turnkey cash flow properties in in various markets that we're promoting. But investors could be partners, could be communication, could be large institutions, could be a whole bunch of investors. So this is a very generic term, but nevertheless, investors are including the home buyers purchase 25% of all the homes that are being available out there in the national housing market, which is the where inventory is severely limited as a result of various factors, which I think you already know. All right. So rental home investors own about almost 10% of all homes in America right now, slightly up to 9% in 2005. That's misleading. Investors own and rent 14.3 million attached and detached U.S. homes. Over the past 22 years, John Burns Consulting have identified 7 major shifts in investor activity that clarify today's discussion of rental home investor and other investor activity. So let's dive deep into this 7 periods, and I'm going to share with you our practical experience during each of those periods, what myself and our investors have done, and how hopefully you can learn something out of it. But when you guys, if you're a mom and pop investor, for example, wherever you're located, California, most of our members are located in California. And but anyway, there's a lot of opportunities out there for investing, okay? And contrary to all the limited beliefs that are being put out into the social media. All right. Number one, back in 2022, 22 years ago, there were 9% of all homes in America are owned by various investors. And back then, 22 years ago, the Wall Street institutions, they have not entered the residential investment housing market, and home flipping was beginning to take shape. We see the reality shows out there like house hunting and fix and flip, all those reality shows that are they are emerging during those times 15, 20 years ago. And anyway, here's about that chart by John Burns. As you can see at the beginning of the 2005, that particular decade, single family home, people owning more and more, investors are owning more and more single family homes. When I say investor, it's a different type of investors, right? You have mom and pop investors like myself and our members. And of course, you have corporate investors, you have syndications, you have fix and flip type of investment asset class activities, and the whole gamut. All right. So this is an investor, for the purpose of this video, is a very generic term. Right. So at the peak, now during the housing crash back in 2008, 2012, on the aftermath, investor activity was not that great. And then at the peak, then after the aftermath of the housing crash back in beginning around 2012, there or thereabout, investor activity has picked up because they're scooping all those amazing historical discounted foreclosure deals out there in the marketplace. We'll go over that momentarily throughout this video presentation. And then throughout the decade of 2012 all the way to 2020, we have decreasing investor activity. And then up until now, the past 2 years, we have some up and down of the investor contribution to the housing market. All right, so let's go on. TTM investor purchase market share. Again, the market share for investment activities, including Wall Street hedge funds, have been fairly low 2 decades ago. Then it creep up in this past decade, the decade of the 2010 to 2020, and then 2021, during the pandemic housing boom, investor activity and other real estate activities have picked up significantly because of the mortgage rate, historical rate, interest rate. So people are able to qualify to buy a lot of homes back in 2021 with the pandemic housing boom. And then, of course, during the last few years, 2022, and up until now, as you can see, the investor activity has decreased, just like any other housing activity, because of the skyrocketing of mortgage interest rate from 3% in 2021 and to as high as 8% in November of 2023. Now, as we speak, today is what? Today is the 18th of May. I think the mortgage rate right now is slightly above 7%. A couple of days ago, it was 6.99%, and these are psychological trigger. 6.99% will potentially bring more people off the sideline. All right. Anyway, then the easy credit boom 2023 to 2026, preceding the housing recession, great housing crash of 2008. A few years leading up to that, of course, we had this mortgage, easy mortgage, the mortgage meltdown, if you will. I'm not going to go over the details. At the end of the day, during this period, everybody that could fog a mirror, can qualify to buy homes. And we're talking hairdressers and barbers and cocktail waitresses, not to dwell on this occupation. But we are seeing these people buying 5 to 10 homes during this easy credit situation. So that created the entire, mainly the mortgage meltdown, the subprime mortgage, if you will, pretty much initiated the housing crash of 2008. And the investors are no different. They bought all kinds of homes with very low adjustable rate mortgage, no doc loans, no NINA loan, no income, no documentation homes. And then at that time, investors owned about 9% of all homes in the U.S. during this period. Of course, with the crash occurred in 2008, 2009, many of these investors eventually lost their property due to foreclosures, and the foreclosure times occur. And then, all right, And then let's talk about Airbnb. Now, Airbnb, even before Airbnb came to the marketplace in 2007, people were doing short-term rentals on their own, right, throughout the nation. But that's the birth of the Airbnb did not occur until 2007, and then people were entering the hospitality industry. So some people don't know how to do the hospitality business on Airbnb, and we heard in these past few years, there are some say sheep and fishing headlines indicating there's an Airbnb, but no, stop the hype. It's not to be a crash, Airbnb but crash. Okay, Airbnb owners are across the U.S. There's so many Airbnb rentals all over the country. For everything is local, housing market is local, and Airbnb are no different. Yes, there is some pullback, but the market margin has decreased over the past few years, and a lot of those players are gotten over their heads with Airbnb rentals. And I'm not gonna go over that. Even right now, there are like around 2 million homes that are in the Airbnb short-term rental space as tracked by various sources. All right. And the Airbnb still is a pretty robust industry, although I should acknowledge there are many cities are they are disallowing Airbnbs, and there's a lot of them. There are pros and cons on it, but we're not going to get into that. All right, and so that's the emerging Airbnb short-term rental market. And then, of course, foreclosure boom right after the aftermath of the 2008 crash. Then, of course, beginning from 2000 until now, especially 2010, 2014, there was so much bargains occurring. I was involved in those activities. My company was selling term homes in various markets, such as in California, Nevada, Phoenix, and Florida, among and even North Carolina. We're selling to our turnkey investors those foreclosed homes for I kid you not, for pennies on a dollar. But anyway, at that time, during this time frame for foreclosure boom, investors rose to 24% of all transactions, right? The peak of the housing crisis. This was an amazing time. At the time, was the greatest time to buy for those courageous people because of the subprime. And anyway, so a lot of homeowners lost their homes, not just investors. And then the Wall Street hedge fund, they started to come back into the market during the early part of 2010. When large rental home investors are typically Wall Street funds are owning at least 1,000 homes, but those are categorized as large corporate institutional hedge funds, Wall Street investors coming into housing marketplace, especially single family homes in many of the Sun Belt markets all over the country. And even then, they were only consisted of 2% of all the single family homes. You see a lot of headlines, people saying the corporate landlords are taking over the housing industry. No, they still, even up until now, they still own a fairly small percentage of all the housing stock throughout the US. All right. So there's no need to overhype and exaggerate the Wall Street landlords are taking over now. Not really. Okay. So let's continue on here. We discussed it. This is a chart of the institutional investors, right? And they, like I said, back in what year was that? So the institutional investors, they started to enter the marketplace at the aftermath of the housing crash. They own, as you can see, a little bit less than 2% of all the single family homes during the majority of 2010 to 2020. Then, of course, it really skyrocketed. And around the last 5 or 6 years, uh, starting around 2020, the they start buying a lot more single family homes, new construction homes in many Southern Belt markets like Phoenix, Nevada, Texas, North Carolina, Georgia, and Florida. All right. So recently, because of the higher mortgage rate and the yield that they expect to get as a result of the higher mortgage rate, institutional investors they decreased their purchasing of all the single family homes. in the last few years. All right, then the iBuyers boom begins, foreclosure boom ends. So 2014 to 2020, we have seen very consistent housing appreciation. And our investors, again, we bought at the bottom back then, and the markets like in Florida, Texas, and Nevada, especially Las Vegas and Phoenix. Many of our investor within our network have purchased a single family home fairly new in Phoenix and Las Vegas around 2012 to 2014, 2015 for like $80,000 to $100,000. Nice home, relatively new homes in Florida also, throughout the many areas in Florida. Those homes were during before the housing crash, they were valued at around $250,000. And then in 2012 to 2014, we were able to scoop up those houses, decreasing value from $250K to as low as $80,000. Is that shocking? How the steep, housing reduction over those homes in a matter of few years after the 2008 housing crash. So those are the great deals. And the investors that bought, our handful of investors that bought in those markets back in 2010 to 2013, they made out, they killed it and they make so much money. And those homes, I don't know how many of our investors that kept those homes, but have they continued to keep those homes? In today's value, it's probably $400,000, $500,000. How many percent they made from their original investment back in 2010? 300, 400% rate of return on their investment? Yeah, that's pretty typical. Anyway, institutional buying activities, we see a lot of depressed during this period. And yes, that's true. And the number of rental homes in America began to decline as many smaller investors sold their homes for profit. Again, my philosophy is buy and hold. I would not sell because that's pretty obvious. But for whatever reason, some investors, they sell their home, they receive a tremendous amount of profit, capital gains, and they move on to do whatever they do. Okay. And then let's see another period, another cycle, short-term cycle, low. Of course, during the pandemic, the 2020 to 2021 and the first 2 quarters of 2022 is another one of those pandemic housing boom, which we will never have ever again unless there's another pandemic. All right. So hopefully we don't want to see another pandemic, another COVID-19. But during this period, investors climbed to 26% of the market. 26% of all the homes were purchased by investors of all types. Okay. And at the end of the year, rental yields far exceeded the treasury yield. Yeah, in those markets, a handful of our investors, we're taking them to Florida, to like Tampa, Orlando, Cape Coral, and a few other places. And then, of course, in Texas, we took our investors during the pandemic boom into Central Texas, also Austin and San Antonio, and also the North Carolina, Raleigh, Charlotte, Chapel Hill, those areas. And those homes at that time, those very nice, almost new construction homes, single family homes. At that time, 3 years ago, our investors buying those homes for around 150 to 220,000 3 years ago, and it rents for like $1,400. The tenant are paying $1,400 now. Many of those locations, many of these few homes that our investors still have to this day, or have increased value by 30 to 50% or more. Many of the homes are right now are priced at $300,000 to $350,000, and the rent have increased on those homes to around almost $2,000 to $2,200. So appreciation have increased, and those turnkey new construction homes that our investors purchased back in 2020, 2021, they have increased 30 to 50%, and the rent have also increased 30 to 50%. And in Midwest properties also increased significantly during the pandemic as well. So we have buyers who bought into Buffalo, Niagara Falls, our Midwest market. At that time, 3 years ago, they bought it for $50,000 to $60,000 to $70,000. Those same homes today are around $80,000 to $100,000. So even in the Midwest market, the appreciation have increased 20 to 30% from the pandemic several years ago. So Now, of course, we are taking our investors to into the deeper suburbs for moderate cash flow with the builder buying down the rates. You could have lower rates to achieve cash flow, and many of those markets are located in South Texas, Central Texas, and Florida, mainly at my different strategic locations that we're promoting positive cash flow homes at 25% down payment. Our home prices were like 50 or 320K single family homes with the builder's rate buy down to 4.99% to 5.5% for 20-year fixed rate mortgage. We still achieve very good cash flow currently. So still opportunity. But we no longer promote the Sun Belt Western region because the home prices have increased so much in Las Vegas and Phoenix and even in Raleigh and Charlotte, and the rent are not caught up in those markets. As a result, we no longer promote those markets because the cash flow and the rent to value ratio and the numbers simply does not work. So we mainly focus on the Midwest market, where even we see very high yield, very high cash and cash return in Midwest market, and the prices are still fairly low, as you know by now. And mainly South and Southeast, we promote new construction, single family homes, all the way up to fourplex with the builder buy down, 25% down payment, and we'll still achieve pretty decent cash flow. All right, so that's what's happening. Get back to the remaining few minutes. Of course, the mortgage rate have shot up from around 3% in 2021 to all the way up to 7% or higher today. So as a result, things have changed, right? And of course, we're promoting in Florida built to rent type of asset classes, as you may acknowledge by now. And if you don't know about our investment methodology, I encourage you to put your email into our website newsletter, and we will become a member of our investment club, and you can receive free email information coming to your email inbox on a very frequent weekly basis about all aspects of real estate investing, free education. All right. So being part of our community of several thousand modern apartment investors. Again, during the pandemic, rapid home price appreciation attracted all type of buyers, obviously, home flippers, people making short-term profits, even twice in a particular year. But I don't do flipping. Okay, we don't do flipping. We buy turnkey property management, buy and hold forever. Okay, the overall decline of rental homes continue. Small rental home investors like us, turnkey mom and pop investors from California, our investment group, we go out of state, long distance, buy remotely, buy long distance, and with the turnkey approach by our various markets in the Midwest and South and Southeast. It's a one-stop shop whereby the property managers will do everything for you, so you can spend very little time managing your portfolio, so you can have the ability to scale your portfolio over time, so you can achieve financial freedom, buying 5 to 10 key rental properties across different markets with a professional property management, so you can achieve your financial freedom within 10 years or so. All right. Of course, with the last period, the last short cycle on this article talk about rising rates. I already discussed that, right? And right now is a very challenging time for a lot of people, but there are always deals that are available regardless of our economic challenges. Today, we're targeting the right market. We put the right teams together in the various strategic locations in the Midwest and South and Southeast. So we will make it easy for out-of-state investors to achieve very good cash flow long term. So regardless of what's happening in the country, inflation fears, housing crash fears, all these doom and gloom negative headlines that come in that we see all the time, that really can mesmerize and cause a lot of people to stay on the sidelines, which is not a good idea. Okay, so large rental investment groups began selling more homes than they were buying in the past 3 years, obviously because of the higher mortgage rates. and more ready-to investors continue selling. Not my investors. Some people sell for whatever reason. They panic or they have some personal reasons to sell. But why sell a nice rental property when when you continue to receive positive cash flow and give some appreciation, of course, and you're able to leverage your 25% down payment. You can raise your rent consistently over time. So you can receive more and more cash flow the longer you hold the property. And then the tenant going to pay down your mortgage for you over time. And then you have a tremendous amount of tax benefits. Each and every one of your investors that you're buying rental homes, 14.3 million homes are purchased by investors, right? And which is considered almost 10% of all homes in America are investment funds. The bottom line, according to this particular article by John Burns, he says investors play a considerable role in the housing market, comprised of 25% of residential real estate transactions. And again, when I say investors, it encompasses all kinds. We'll talk about multi-units, we'll talk about single-family home, 1 to 4 unit, small mom and pop investors like our investment group, and we'll talk about flippers, and we talk about syndication, all aspects of investor. It's a generic terminology, okay? But anyway, 25% of all the homes bought and sold today, 2024, almost a quarter of our homes are purchased by investors. Just to share with you, there's still money to be made. So there's still a lot of money flowing into real estate as we speak, because out of the 25% of our investment homes that are being purchased right now, a lot of them are by all cash. At least 20 to 25% of all the residential homes are purchased by cash. So there are money still flowing into the real estate markets. No matter how good, bad, or how all those negative information that are brainwashing into our brain by those that crash world. Anyway, yeah, again, this article says investors come in many shapes and sizes. And in fact, we need to have a further breakdown of the different type of investors. Of course, I don't have time to go over that. At the end of the day, my takeaway is, yes, we discussed 7 periods of investor activity per John Burns consulting and research firm. But from my personal opinion, it doesn't matter, right? If you buy a property, you buy and hold. As long as you collect cash flow, you buy in a good market, you surround yourself with a good trusted team on the ground in those areas that do properly professional property management, regardless of where you live in the country, especially if you live in a high price market, like many of our investment investors are located in California. You have the ability to buy long distance, buy remotely, doesn't matter how far or how close it is, as long as you do your proper research, you buy in a robust market, a market that has low, affordable, entry-level homes for investors. We target low, affordable homes that are less than the median price of homes in those particular market. We match the rent versus the value of the property. Ensure we achieve proper cash flow, 25% down payment or so for the 1 to 4 unit, especially. As long as you do that with your allowing trusted professional property management to manage your homes, then we invest for the long term. Invest for the long term, you really don't care about the short-term volatility. Whatever negative doom and gloom, the sky's falling information you are hearing out there, there's no fear, because you buy in a market that have a good rental market, you have a lot of renters, which is the case. Right now, it's a renters nation, in case you're not aware of. The home affordability index is the lowest in history, so a lot of people are renting these days because housing has been skyrocketing, and a lot of people cannot afford to buy homes. They have to rent. In the meantime, stay the course. Don't let the short-term volatility affect your long-term goals, and let your tenant pay down your mortgage. Let the tenant make cash flow for you. Invest for long term. Historically speaking, real estate is we did invest 7-10 years over time. Real estate prices will always increase. All right. Thank you so much for watching. If you receive any value from this video, please like and subscribe to my channel. And also, again, subscribe to email our website below. And so you can receive weekly free email newsletters about all aspects of real estate investing. Thank you so much for watching. I'll see you on the next video. Nice day. Bye bye.